Pay yourself first. Is life getting in the way of your savings goals? It can be hard to tuck money away when you have bills to pay and essentials to buy. By the time you've taken care of your monthly needs, and maybe a few wants, your bank account might be just about empty. Then you're stuck waiting until your next paycheck before you can try to set aside some money for the future. If you often find yourself in this predicament, you might benefit from the pay yourself first budgeting approach. This strategy places your savings goals at the top of your financial to-do list, ensuring you take action on them before your hard-earned cash goes anywhere else. What is the pay yourself first method? The pay yourself first method has you put a portion of your paycheck into your savings, retirement, emergency, or other goal-based savings accounts before you do anything else with it. After a month or two, you likely won't even notice this sum is gone from your budget. When you add to your savings immediately after you get paid, your monthly spending naturally adjusts to what's left. Paying yourself first can be effective because it ensures you save something every pay period, and it eliminates the possibility that you'll spend what you plan to save. How do you pay yourself first? Paying yourself first requires balance. You should choose a reasonable amount or percentage of your check that won't leave you unable to pay your bills or meet other financial obligations. But you'll still want to try to save enough to make a difference in your savings account balance. To find the sweet spot, you'll need to take a close look at your budget. How much should you pay yourself each month? To determine how much is the right amount for you to save each month, you'll need to craft a budget. Here's a rundown on how to pull together a fairly simple view of your income and expenses. Determine your monthly take-home pay, which is your income after taxes and retirement contributions are withheld. Set aside some money for savings. Review your expenses, including housing, utilities, loan payments, transportation costs, childcare, food, medical expenses, and other bills. You can use a budgeting app for this. Plug these numbers into this equation. Income minus savings minus expenses equals spendable. The result is your spendable income, or the amount of money that's available to spend without putting any essential bills, or your savings, in jeopardy. Make sure you're happy with the amounts you're saving and spending, and ask yourself if there are opportunities to spend less. When you find ways to cut expenses, you can use the money you're freeing up to boost your savings. Making the savings automatic. Once you've arrived at a number you're comfortable with, you can set up automatic payments to ensure you always get paid first. This money shouldn't stay in the account that you use day to day because it would be too easy to accidentally spend or lose track of. Choose or create a specific savings or investment account that you'd like the money to get paid into. One idea is to set up a split direct deposit so that for each paycheck, the pay yourself first money goes into your designated savings account while the rest goes to your general checking account. Another option is to set up a recurring transfer that moves money from your general account to your designated savings account at a certain time every month or pay period. Is paying yourself first right for you? Putting this strategy into action is pretty straightforward if you decide to do it. Before jumping in, though, give thought to whether paying yourself first will work for you and how it might affect your other financial goals. If you're on a limited budget. If 100% of your earnings go to necessary bills, then you're living paycheck to paycheck and it's not going to be possible to pay yourself first. In that situation, you're better off focusing on other strategies to grow your income, make your lifestyle more affordable, or decrease your debt. If you're not on any budget. Paying yourself first is also unlikely to be helpful if you don't adhere to a budget. Spending without limits or taking on credit card debt could outweigh the benefits of setting aside savings. You might benefit from controlling your discretionary spending before setting out on this strategy. But if you have room in your budget for savings and can adjust your spending as needed, then paying yourself first might be a worthwhile endeavor. If you're paying down debt. Under this method, it's assumed that you're making at least the minimum monthly payments on debts as part of your mandatory expenses. That may not be enough, though, if you're trying to reduce significant debt. The trade-off between growing savings and paying down debt is complex. But there are a few general guidelines to keep in mind. You may want to go ahead with paying yourself first and stick with minimum monthly payments on debts for now, if you haven't established an emergency fund yet. Once you've built up some emergency savings, you could pause paying yourself first and instead direct as much money as you can to reduce your debt. You should compare the interest rates you're paying on your debts with the rate of return you get on your savings. If you're dealing with high-interest debt, paying it down might be the more urgent priority. But you might want to go forward with paying yourself if, for example, the rate you earn on your savings exceeds the rate you're charged on a loan. Other factors that could tip the balance between debt payoff and savings are whether your debts are secured by collateral like your home or car, in which case it could make sense to prioritize paying them off. And if you haven't started saving for retirement yet, that could be a reason to put debts on the back burner and pay yourself first. Also, it's possible that it doesn't have to be an either-or decision. If you calculate that you can save 40% of your discretionary spending, you might choose to pay yourself with 20% while the other 20% is used to pay down debt. Then, you can increase the savings amount after you've made progress on your debts. Why this approach works? This approach increases the likelihood that you'll save a substantial amount. It converts saving money from a desire into a necessity. Only after you have paid your mandatory expenses, including your long-term saving and insurance, will you know how much you have available for discretionary spending. The order is important for another reason. It may be harder to cut things like TV streaming or a gym membership in order to put $400 in your retirement account every month. But it's a lot easier to eliminate TV streaming and gym memberships in order to pay your rent. By saving before you pay your bills, you put your other mandatory expenses at risk. This makes it more likely that you will eliminate discretionary expenses in order to keep saving. Is the pay yourself first budgeting method right for you? Like most things, whether this budgeting strategy is for you will depend on your unique situation and finances. One of the perks of using this budgeting method is that it's pretty hands-off and can take just a few minutes to set up. So if you're looking for something more streamlined, it could be a good option for you. And once you've figured out your income, savings goals, and how much you feel comfortable putting into your savings account, turning those plans into action is as simple as automating your savings within your existing bank account. You can usually do this through your online bank account, mobile app, over the phone, or in person at your bank's branch. All you have to do is select the amount you'd like to transfer into your savings and how often those transfers should be made, and then you're all set. You can have direct deposits set up so that a portion of your paycheck each month goes directly to your savings account. And if you feel like keeping your savings and checking accounts under the same roof may tempt you to overspend, you can also opt for a bank account at a different bank to keep things separate and keep working toward your goals.